That's right. We love Pep. I love Pep. We're talking about Pepsi here. They just put out their earnings, which of course, newsflash, they beat. They always seem to beat, which is why they are one of my favorite dividend growth companies, and they have been growing the dividend for 49 consecutive years. So they are just on the cusp of becoming dividend kings. So we will bow to the king when that happens. But until then, I'm Russ. This is Dapper Dividends. Thanks for swinging on by the channel where we talk about dividend stock ideas, news, and analysis. And if that's something you're all about, please click the like button. It means the world to me and it's free for you. So just like the hashtag says, dividend porn, I have been buying a share of Pepsi every week for the last 69 weeks almost. And I just got another round of dividends in, which was good for $67.73. So we're super excited about that. And we want to hit 100 because then we can start selling covered calls on those and bringing in even extra money. Every 3 weeks or so is probably the length that I'm going to sell those for. But let's not put the cart before the horse, and let's get into some of Pepsi's earnings and why they may be about to crash and why I'm not worried at all. And I am going to gladly keep buying my beautiful big blue chip PepsiCo. So PepsiCo did report today and they topped the estimates despite the higher supply chain costs. Earnings per share was $1.79 versus $1.73 expected. So far, revenue has brought in $20 billion versus $19 billion expected, and the net income for the quarter that ended on the 4th of September was $2.22 billion or $1.60 a share. And something to keep in mind, that is down from $1.65 per share a year earlier. So I love it that they raised their guidance for all of 2022, and we've barely just begun the fourth quarter. So that is just real ballsy from Pepsi, and I love that they're doing things like this. The net revenue growth for the quarter up 11.6%. And what I like to see is the organic revenue growth is 9% for the quarter. And organic revenue growth is any of the money that came in that was not from any mergers, acquisitions, or divestitures. I won't bombard you with all of the financial statements, but one thing I did like that I'd like to point out to you is that their long-term debt from a year ago has dropped 8%. So I love to see them paying off that long-term debt. Now, it's no secret that there's a bunch of supply chain bottlenecks going on, and we've got ships sitting off of the coasts. And it's going to affect every company. It's basically inescapable. We have rising commodity prices. So on Yahoo was CFO Hugh Johnston, PepsiCo CFO Hugh Johnston, and this is what he had to say about PepsiCo raising their prices.
You know, we really have been investing heavily in our brands, and we've been investing heavily in innovation across really all of the various subcategories that we play in, snacks as well as beverages. And I think we're providing products that consumers are willing to pay more for. So, you know, with the differentiation that we have and with the fact that our brands are as loved as they are, I think there is a willingness to pay more for those types of products. In addition to that, I think more broadly, consumers to some degree have been conditioned to price increases across a variety of categories. There's really no company that's immune to what's been happening in terms of commodity as well as operating expense inflation, and everyone's prices are going up a little bit. In a world where prices are increasing, again, on a relative basis, our prices are still somewhat low. And as a result of that, we're that simple treat or that simple pleasure that people choose to enjoy. And it's worth it to them to pay a little bit more for it. So the elasticity has been relatively low on these price increases, and I expect that'll be the case across 22 as well.
Now, I love that they're just saying we're raising our prices, but we have such good products and we know that people want our products. They're in such demand that people are going to pay those increased prices, and that is prices and that is pricing power. And we want to look for companies that have pricing power when they can raise their prices and people love it so much that they're just going to keep buying it. If you've been around the channel, you know I've been talking about the hard Mountain Dew. I don't drink soda. It just is not something that agrees with me in my advanced years of 43, but Hard Mountain Dew looks really, really interesting, and this is what I love about PepsiCo innovating and pushing the envelope and trying new things, whether it fails or not. I just love that they're trying. So they asked Hugh Johnston about Hard Mountain Dew.
It's a very big category. It's a category with lots of attractive characteristics, both financially and from a consumer perspective. And it's in an area that we're familiar with. We wanted to make sure that we had a partner that we felt like we could collaborate well and innovate well with. And Boston Beer is terrific in that regard. Dave Berwick, who is the CEO of Boston Beer, is a former PepsiCo executive. He understands his business and he understands what we do pretty well. So we kind of see this as a really interesting opportunity. And we're hoping it's a really big opportunity. So we'll see how it plays out over time. You'll see the first products in the first half of next year, and then we'll take it from there and see how big we can make it.
One thing I like and one thing I don't like is that the total cash returns to shareholders, as us in dividends, was approximately $5.8 billion. So we'd love to see that money coming back. Now, their free cash flow payout ratio, that's how much of the dividends is being paid out of the money that's left over to pay everything else. The free cash is about almost 80%. It's 79% and change. So that's a little bit higher than I like it. But PepsiCo is just such a strong company that I think they're going to be able to keep paying that. And one thing I'm not too happy about is that they have repurchased $106 million worth of shares, and that's it. They say they're not repurchasing any more shares during the remainder of the 2021 year. So we love share repurchases around here because that means there is less shares to spread the earnings over. So that just is going to increase the earnings per share. And on top of dividends, we like to say those are double dividends. So we did say that they are paying down their long-term debt, which is good. Something to keep in mind is that their current liabilities exceed the current assets, and the current means due within 12 months. So that's just something to keep in mind. I think long-term debt is a little bit more important, but all debt is important. It all has to be paid. And PepsiCo is not going to have a problem paying that debt, though, because I love looking at the interest coverage ratio. This shows how many dollars of operating income do they have to pay every dollar of interest expense. As we can see here, there is $10.23 currently of operating income to pay every $1 of interest expense, so they can easily cover the interest on their debt. So the price has been dropping off the highs, which is great for me because, you know, when I started this experiment of buying one share a week, it was down in the high 120s, low 130s, I believe. And it's just been creeping up, and pushing 160 was getting a little painful because even I think it's a little bit overvalued, but I'm putting my money where my mouth is. And I think in 10 years, this will look like a really good and attractive price. So I'm locking it in now. And always remember that when I buy, I'm always looking toward the future and the income that's coming in from the dividend. So more or less, I like to think of the share as a sunk cost, and I'm only going to be receiving the dividend income if I was theoretically never able to sell a share of the business. Now, I say it could be dropping, and I know a lot of you aren't into the technicals, but here's a little bit of technical analysis. This is a chart pattern called the Head and Shoulders pattern. Each one of these is a Japanese candlestick, and it represents a period's trading price. You see the open and the close, and then the lowest the price went and the highest. So they could be for every 5 minutes, every hour, day, week, month. But anyway, so there's a pattern called Head and Shoulders, and this is bearish, meaning that it is probably indicating a price trend reversal. So the first shoulder, the price hits a bit of a high spot, comes down to support, goes higher than the first shoulder as the bulls regain control and drive the price up, but that dies out a little bit. Price comes down, bounces off a support, comes back up, retests sort of close to where that high was again from the first shoulder, and then fails, and momentum, it pulls it all the way back down. And you can see here on this wonderful chart I've made for you that we do have a bit of a head and shoulders pattern, right? Pretty cool. Watch this go. Whoop. Head and shoulder. Watch out. head and shoulder. So I see a head and shoulder pattern, and look at the two shoulders, 157.58, 157.42, so really close. And there's that head at 158.54, and it's come down all the way past the support of about 153-ish. So that means that's telling me we could be seeing, and this could be indicative of the overall market, but a price reversal, a trend reversal is most likely along the way. And why does that excite me? Because as you know, around here, when the price goes down, the yield goes up. Somebody goes home with the cup. He's going the distance, that is cake for all y'all youngsters out there. So, anywho, the beta on Pepsi is 0.62. What the hell is beta? Betamax. I love Betamax. If you remember Betamax, let me know in the comments down below. But beta is how the stock moves with the overall market. So if the market goes up $1, this means that Pepsi is going to go up 62 cents. But then the inverse is true. If the market falls $1, Pepsi is going to only fall about 62 cents. So the lower the beta, the less volatile it is, the slower that the price moves. So 0.62, that is pretty good and not too terribly volatile. So we don't have to worry about wild daily fluctuations in the price of Pepsi in comparison to the overall market. So of course I'm happy to buy lower. The dividend yield currently 2.86%. They're paying out that $4.30 annually. I'm sorry, every year. They're paying $1.08 quarterly. So you can get tongue-tied sometimes. And the 5-year growth rate, they're pretty in line always at 7.59%. And again, remember the payout ratio. This is earnings per share. Earnings per share can have a lot of manipulation baked into it. So I usually like to look at the free cash flow payout ratio, which is about 79, almost 80%, a little bit high. And again, they have been growing that dividend for 49 years. Caught me. So I'm so happy with my PepsiCo earnings, and it's why I am putting that money. I'm putting our money 1 share a week for 100 weeks, so we get 100 shares. Yes, they'll be a little bit outsized, but when I hit 100, I'm just going to put that into other things, and it'll eventually start to come back down as a percentage of my portfolio. And if you would like to show something in your portfolio that you're getting in dividends, please do. Hashtag dividend porn. Nobody else is really using that. I did a Google, and I've used it a few times on Twitter. That's what this stems from. If you'd like to see exactly where we were at our 50th week of Pepsi and every price we bought each share at, click the video right here. Be safe out there, and I will see you in the next video.